Hi everyone, welcome back to my ACCA videos. Today I'm going to be talking about planning and operational variances. Planning and operational variances are quite similar to your previous variances that we had seen, except that here we are trying to split a variance into that part which is controllable and the part which is beyond our control. So when we calculate variances, we always try to find the difference between what something should have been compared to what it actually was. And the reason we calculate these variances is to try to understand why this difference happened and what we can do in the future to control it. Say, for example, you were supposed to sell something for $10, but in reality, you only sold it for $7. So it's a very simple variance. We calculated as $3. And then we say, we sold it for $3 less, and we try to find out why we sold it for $3 less. But now what if I told you that originally the plan was to sell something for 10, but actually the market rate of that product was only $8, and then you sold it at 7. So if I were to say that you sold it for $3 less is entirely your fault, you're responsible, that's not fair. Because how can I expect you to sell something for $10 if the market price itself is $8? So here the variance is still $3 because we were supposed to sell it at 10, but we sold it at 7. But now what I'm going to try to do is split this $3 variance and do a planning variance and operational variance. So if I say the actual market price of that product is 8, then I'll say our original budget or our original plan of selling it at 10 was wrong and it should have been 8. So this variance of 2, this is a planning variance. Why? Because our plan itself was wrong. And then we were supposed to sell it at 8 because this is now the market price, but we sold it at 7. So we sold it for $1 less. This is your operational variance. So what have we done? We have split basically the original variance of $3 into 2 and 1. That is planning and operational. So to sum it up, a planning variance is a variance for which you cannot be responsible yourself. This is a planning error. And then the variance for which you are responsible, you're accountable, or something that you could have controlled is a operational variance. So let's have a look at it in a bit more detail. So planning variances are calculated by comparing the original budget or your original standard cost with the revised budget or the revised standard cost. So say for example, in this case, we can say our budgeted cost was how much? $10, whereas the revised cost was $8. So the difference between these two, that is $2, is your planning variance. Then operational variances, they are calculated as your normal basic variances, except that they are based on a comparison between actual results and the revised budget or standard cost. So this time you're going to look at your revised cost, that is $8, and your actual cost, that is $7, and hence the variance is 1. Now, depending whether this is material cost variance, that is material price variance, or your selling price variance, these differences of 2 and 1 may either be favorable or adverse. So basically, the variance is nothing new. It is simply splitting a variance between what is controllable and what is non-controllable. Whatever is controllable is an operational variance. Whatever is beyond your control, that is a planning variance. Now, we can basically calculate a planning and operational variance for any variance that exists over there because, like I said, it's simply splitting between controllable and uncontrollable. Now, there's a specific variance called market size and market share. These are the variances which are related to your sales volume, but they follow the same concept, that is planning and operational variances. So if you remember, in sales variances, we had seen two different types of variances. One was a sales price variance and the other was sales volume variance. When we look at sales volume variance, again, we'll try to see the variance in the volume based on what was planning variance and what was operational variance. So when you have a planning volume variance, we call it a market size variance. And when you have a an operational volume variance, we call it a market share variance. So market size and market share are nothing but planning sales volume variance and operational sales volume variance. And the idea is the same behind it. When you're considering the volume of the number of goods sold, we're simply seeing how much was the variance. Out of that, how much was because of our control capacity and how much was beyond our control. So Have a look at the statements here. It says when the sales budget is revised, it may be assumed that the revision to the sales budget was due to a reassessment of the total market size for the organization's product, but the sales management should still be expected to win the same market share, that is, the proportion to the total market size as in the original budget. So, what it basically means here is if your market size is increasing or decreasing, you will need to revise your budget accordingly, and this will be your planning variance. But based on your new revised budget, you should be able to achieve that. Whatever you overachieve or underachieve, that is going to be your operational variance. So a sales volume planning variance, or also known as the market size variance, is caused by the difference between the sales volume in the original budget and the sales volume in the revised budget. Whereas the sales volume operational variance or the market share variance is caused by the difference between the actual sales volume and the sales volume in the revised budget. So remember, you're calculating your sales volume variance in exactly the same way that we used to do before, except that this time you're calculating two variances. One between your original budget and your revised budget. This will become your market size variance, and the other variance you'll calculate is your revised budget and actual results, and this will become your operational volume variance or market share variance. So let's consider an example over here. Let's say your budgeted sales units were 5,000 units, but then you realize that in the market, the actual market size is only worth 4,500 units. So the difference between these two, this is 500 units adverse, this is your planning volume variance, or simply say market size. Now, as per your revised budget, you were supposed to sell 4,500 units, but you sold only 4,250 units. Again, the difference between these two, that is, you sold 250 units less. This is what? This is your operational volume variance, or simply market share. And that is how simple it is to calculate a planning and operational variance when it comes to sales volume. Now, just like sales volume, when we multiplied it by your standard contribution or standard profit, we'll do exactly the same thing here. So when you're calculating the size variance, we'll simply say 500 units adverse into your standard contribution, which is given to us $10. Our variance will be $5,000 adverse. And in terms of share, it was 250 units that we sold less. So 250 units into $10, again, your standard contribution, it will be $2,500 adverse. So it's this simple to calculate your volume variance. Let's have a look at a slightly more complicated example. It says over here, KSO budgeted to sell 10,000 units of a new product in the year 2000. The budgeted sales price was $10 per unit and the variable cost was $3 per unit. Actual sales in the period were 12,000 units and the variable cost for those 12,000 units were $30,000. But the sales revenue was only $5 per unit. So remember, as per original budget, we were supposed to sell it at $10 per unit, but now we were able to sell it at only $5 per unit. With the benefit of hindsight, it is realized that the budgeted sales price of $10 was hopelessly optimistic and that a price of $4.5 would have been much more realistic. So here we have some basic information. Now remember, this time we are not just talking about the size and volume, we are also talking about your price variance. So when it came to volume, we have already seen how the volume variance works. This time we'll look at the size variance and see how can you split the sales price variance into your planning variance and operational variance. So simply looking at it, we know how much was our original selling price. Our selling price was $10. Whereas what is our revised selling price? Let's say this was the budgeted selling price and this is the revised selling price. Revised selling price is supposed to be $4.5. So here there's a difference of how much? $5.5 per unit, and this is adverse because our realistically selling price of 4.5 is way less than $10. Now, just like you were calculating your selling price variance by multiplying it by the actual quantity sold, we will simply say $5.5 per unit into 12,000 units. What we get is a variance of $66,000, and this is going to be adverse. This is your selling price variance, planning variance. Now when we go to operational variance, so let's say this was planning and now we'll go for operational. So operational, remember now we are going to compare what? Your revised sales price, which is nothing but 4.5 compared to your actual selling price, which is $5. And here the difference is $0.5, and this is favorable because you are actually able to sell it for 50 cents more than your revised selling price. Again, do the same thing, that is into 12,000 units, that is your actual quantity sold, and what you will get is $6,000 favorable. And hence we say, as per your planning variance, your selling price variance was $66,000 adverse, but as per operational variance, your selling price variance is actually $6,000 favorable. So what does this actually mean? What this means is, had you been able to stick to your original budget, you should have been able to sell 12,000 units for $10. But we sold it for how much? Only $5. So that difference of $5 is not your fault, because remember, realistically, the market price is only 4.5. So this difference of 5.5 is not the management's fault, and hence we say the planning variance is $5.5 into 12,000 units, that is $66,000 adverse. But instead of selling it at 4.5, now you sold it at $5, and this is something you are responsible for. This goes to your credit that you were able to sell it for half a dollar more. And again, you sold 12,000 units, so 12,000 units into $0.5, that is this, you get $6,000 favorable. And this is how you calculate your selling price variance and split it between planning and operational variances. So in the pretty much the same way, like I said, you can calculate planning and operational variances for any variance that is out there. We'll have a look at another example or question which involves material price and usage variances. So what we saw earlier was your sales volume variance, which was market size and market share. Then we saw an example on sales price variance. Now we'll have a look at material price and material price and usage variances. Similarly, you can calculate it for labor and everything else. So we'll stick to material here. So have a look at this particular question. It says the standard material cost for a product is 5 kgs into $7.5 per kg, and hence the total material cost should be $37.5. Actual production of 10,000 units used 54,400 kgs at a cost of $410,000. So you have your budget, you have your actual. Then in retrospective, it was realized that the standard material cost should have been 5.3 kgs per unit. That means instead of using 5 kgs, you should have used 5.3 kg per unit at a cost of $8 per kg. The standard cost was revised to this amount, and now we'll try to calculate the planning and operational price variances as well as the planning and operational usage variances. So let's just summarize the data that we have over here. Our budgeted data says that the material should be used how much? 5 kgs, whereas your revised budget or your revision says that the material should be 5.3 kgs. And then you have the actual data where we say the material was used how much? 54,400 kgs total. Likewise, the cost should have been over here 7.5 per kg, whereas in retrospect, we said it should have been $8 per kg. And in reality, we paid how much? We paid $410,000. So any variance between your budgeted and revised will become your planning variance. Okay. And here, any difference between your revised and actual will become your operational variance. And in this case, we'll calculate both your price variance as well as usage variances. So let's have a look at the first one. First one we'll calculate is your material price planning variance. So remember, this is the difference between your budgeted price and the revised price. So remember, your budgeted price was how much? $7.5, whereas your real price or your, sorry, not the actual price, but the revised price should be $8. So here the cost is increasing by $0.5, and since the cost is increasing, this is going to be an adverse variance. And then remember, just like we calculate our material price variance, we do it how? The difference between the standard cost and the actual cost multiplied by the actual materials used. So here we are saying the difference between your budgeted price and the revised price into actual materials used. So how many materials did we actually use? We used 54,400 kgs. We multiplied by $0.5 adverse, and what we get is $27,200 adverse. So you have calculated a material price variance, but not between the original budget and the actual price, but between the original price and the revised price, which was 7.5 and 8. So the difference was 0.5 into your actual quantity used, that is $27,200 adverse. Likewise, let's have a look at material usage planning variance. Now, again, this is a comparison between your original budget and revised budget. So going back 2 screens, remember your original budget said you're supposed to use how many kgs? 5 kgs, whereas the revised budget said you're supposed to use how many kgs? 5.3 kg. So you're supposed to use now 0.3 kg per unit more. So in this case, we'll simply say when we produced 10,000 units as per original budget, we were supposed to use 50,000 kgs. But as per revised budget, we are supposed to use how much? 5.3 kgs per unit, and hence 53,000 kgs. So as per your revised budget, you're supposed to use 3,000 kgs extra, which means it is 3,000 kgs adverse. Now remember how we calculate our material usage variance. It is simply the difference between what should have been used and what was used into your standard cost. That is your original cost of your material. So in this case, our original cost of material was $7.5 per kg. Remember, you're going to consider the original cost and not the revised cost. So 3,000 kgs into 7.5, you get again $22,500 adverse. And this is your planning usage variance. So now we have calculated two variances, that is planning price variance and planning usage variance. Now what we look at is your operational price variance and operational usage variance. Exactly the same way that we calculated these two, except that now we will compare the revised cost and the revised usage compared with the actual cost and actual usage. So material price variance, operational variance. So in this case, now we say how many kgs did we use? That is the actual quantity used, 54,400 kgs. And as per price, the revised price was how much? $8. So 54,400 kgs multiplied by $8, it should have costed us $435,200. But in reality, that is the actual cost. It costed us only $410,000. And hence we used $25,200 less. And this is your favorable variance. Another way of calculating this is based on what you could do is you could divide $410,000 by 54,400 kgs and you'll get the cost per kg. So let's just do that quickly. So what we get over here is roughly 7.54. Now remember, this is a rounded off figure. In reality, the cost per unit is something much lengthier than this. So as per our actual, this is what we have actually paid per kg, whereas what we were supposed to pay was $8. So the difference between this is roughly 8 minus 7.54, you get 0.46. And this is the savings that we have because we actually spent less than $8. So this is going to be favorable. And then we simply multiplied by 54,400. You will not get exactly 25,200. You will get something like 25,024 or something like that. Because remember, this is a rounded off figure. If you do not round it off, then you'll get it exactly as 25,200. So you can use either of the ways. You can either calculate your actual cost per kg first and then do that calculation, or simply do it the way it has been shown in this slide. And then lastly, you have your material usage operational variance. So again, remember, as per your revised budget, 10,000 units should have taken 5.3 kgs per unit, and you should have used a total of 53,000 kgs. Whereas in reality, you used how much? 54,400 kgs. That means you used 1,400 kgs more. And this is again adverse because you've used more material than you were supposed to. again multiplied by your standard cost, that is your original cost and not the revised one, and what you get is $10,500 adverse. And this is simply how you calculate your planning and operational variances. So once again, to recap, your planning and operational variances are not anything new. They're simply splitting your original variance between something which is controllable and something which is beyond your control. Whatever is controllable is known as operational variance, and this is simply the comparison between your revised results and actual results. Whereas whatever is not in your control is known as a planning variance, and this is the comparison between your original budget and your revised budget. So this is how you calculate planning and operational variances. So hope these examples were sufficient to explain the difference between your planning and operational variances and how to calculate these variances. And like I said, in the similar way, you can also calculate labor variances and split them into your planning and operational variances. So we have seen the planning and operational variances, market size, market share, and so on. If you have any questions, please feel free to contact me. I'll get back to you as soon as I can. And do subscribe to my channel and share the link with whoever you feel can benefit from these videos. Thank you for watching and stay tuned for my next video. Thank you.